Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Good morning.
Today, we're really diving into a collection of recent reports. We've got stuff from Bloomberg, CNBC, MarketWatch, CNN, basically getting under the skin of what's been moving the financial world this past week.
Yeah, quite a mix. We're seeing tech shifts, crypto volatility, trade policy. It's all connecting.
Exactly. We'll unpack everything from, Alphabet's search engine worries to Bitcoin popping back up and the really widespread impact of the latest trade news. So buckle up. It's going to be a rapid but hopefully thorough look at what's shaping things right now.
Sounds good. It really is fascinating how these different threads, tech, crypto, trade, they're all weaving together, creates a pretty complex picture for everyone, investors and businesses.
Uncertainty seems to be the watchword.
Absolutely. And needing to adapt fast.
Okay, let's kick off with the big one. Alphabet. Bloomberg had a piece on May 9th. Alphabet shares take a $120 billion blow as search warnings blare. Wow, $120 billion market value drop this week.
Yeah, that's a huge number. It definitely got everyone's attention.
What's the core worry here? Is it just future stuff, or are we seeing real-time effects?
Well, the Bloomberg report really hits on the vulnerability of their search business. I mean, that's the cash cow, right? Revenue, profit, it all flows from there.
Right.
So any threat, even a perceived one, is going to spook the market. And the immediate trigger seems to be this Apple news.
The court testimony.
Exactly. Eddie Q mentioning they're thinking about adding AI services straight into Safari. Now, you got to remember, Google apparently pays Apple, like $20 billion a year?
$20 billion, just to be the default search.
Yeah, so that tells you how important that Safari spot is.
So if Apple builds its own AI search, Google could lose that desaught spot.
Yeah.
And a ton of traffic.
That's the implication, yeah. And here's the kicker. Q also said Safari searches actually fell last month for the first time.
Oh, wow. So it's not just theoretical.
Right. It suggests maybe these AI tools, OpenAI, Anthropic, maybe they are already chipping away at Google's share, even just a little bit. Art Hogan from B. Riley Wealth Management, Bloomberg quoted him saying, "This is basically the first real competition Google's faced in search. Ever."
It does feel like the market's just incredibly sensitive to any hint Alphabet might be losing its edge in AI, particularly search.
Totally. And Bloomberg reminded us about those earlier stock dips, like when ChatGPT first landed.
Yeah. Why is that narrative that Alphabet's maybe falling behind? Why does it stick so hard?
Well, maybe there's a perception, right or wrong, that while Alphabet has tons of AI tech, they haven't quite, translated it into those game-changing products like some others have.
Like ChatGPT grabbing headlines.
Exactly. That showed a new way to interact with info, and the market's constantly asking, okay, who's really leading this AI future? So these sell-offs, they reflect that kind of nervousness, that fear that maybe Google's search dominance isn't guaranteed anymore.
Now, Alphabet did put out a blog post, Bloomberg mentioned it, said search queries are still up, even from Apple users. Did that help at all? Calm things down?
Maybe a little. It seemed to slow the bleeding somewhat, put a bit of a floor under it temporarily.
But still, $120 billion.
Right. That kind of hit tells you the underlying worry about, the long-term disruption. It's still really strong. A blog post saying everything's fine doesn't quite cut it against the threat of Apple maybe walking away in this bigger AI anxiety.
People want to see action, not just words.
Pretty much. Concrete product stuff, proof they're defending their turf.
Bloomberg also mentioned Alphabet's valuation, their price-to-earnings ratio, has slipped compared to history and peers like Microsoft. What does that actually signal to, regular folks?
So think of the PE ratio as basically how much investors are willing to pay for $1 of the company's profit. A lower PE can mean less confidence in future profit growth or maybe seeing more risk.
Okay.
So for Alphabet, seeing that PE drop, especially compared to Microsoft, which is all in on cloud and AI, it suggests the market is pricing in more uncertainty. Can Alphabet really keep making that much money if search gets seriously challenged?
It's weird, though, because Bloomberg also reminds us Alphabet still has, almost 90% of the global search market as of March.
89.7%, yeah. It's still massive, almost a monopoly.
And most analysts on Wall Street, over 80%, still say buy the stock.
Yeah.
It feels like a huge disconnect between the market freaking out and the analysts' longer view.
That's a great point. It highlights that tension. The market reacts fast, right, to threats. But analysts often look longer term. They see the huge existing business, YouTube, their AI investments.
Like Mark Mahaney at Evercore ISI saying buy the dip.
Exactly. He's quoted saying, revenue's still growing consistently, even if search volume growth is slowing. It's a belief that the core is strong enough and there's other value there.
But Bloomberg also had that cautious note from Melius's Ben Reitz's, saying maybe 2025 profit estimates are too high, given trends in paid clicks.
Right. So even among the analysts, there's this growing sense that things are changing, and it could hit the bottom line.
So the key takeaway for you, the listener, is that Alphabet's valuation is really up in the air right now.
Yeah, that long-held idea of unchallenged search dominance. It's being seriously questioned for the first time, really. And investors are scrambling to figure out how Alphabet fights back in this AI world. It's a big moment, shows even giants can be shaken.
Okay, let's shift gears. Bitcoin, another big mover. We saw reports from CNBC. Bitcoin jumps above $100,000 for first time since February. And MarketWatch, Bitcoin rallies with stocks that top $100,000 again. So back above 100K. What lit the fire this time?
Well, both CNBC and MarketWatch pointed to a couple of things. Seemed to start bubbling up after President Trump teased that US-UK trade announcement.
Ah, the trade link again.
Yeah, the idea of maybe smoother global trade often kicks off that risk-on feeling, right? And that seemed to lift stocks and Bitcoin. Then when the deal details came out, it just kept going.
MarketWatch called it a broader risk-on revival. So even though some people talk about Bitcoin as a safe haven, it's mostly just moving with general market mood.
That's a really key observation. Yeah, while some might use it as a hedge sometimes, a lot of its price action just tracks the overall appetite for risk. Leah Wald from SOL Strategies, MarketWatch quoted her basically saying it's a high beta risk asset, more volatile than the market.
But Antony Trenchev at Nexo, CNBC mentioned him. He sees it as Bitcoin's bounce-back ability. He also pointed to other things, like maybe more crypto-friendly Trump admin, plus all that buying from the spot ETFs.
Right. Trenchev's looking more at the crypto-specific stuff, those ETFs making it easier for big money to get in. That's definitely a big factor driving demand.
And the regulatory angle, too.
For sure. A perception of a friendlier environment helps confidence. But he also wisely pointed out, it's still going to be tested, right?
Yeah.
Geopolitics, what the Fed does, those things still matter a lot.
It is interesting, though, CNBC noted that since Trump started the tariff stuff in early April, Bitcoin's up over 17%. That's better than gold and the S&P 500 in that time. That kind of complicates the simple risk-on story, doesn't it?
It does, yeah. That outperformance during trade uncertainty is, well, it's intriguing. It shows Bitcoin's drivers are complex. Maybe sometimes it does act like a hedge against certain kinds of economic jitters. It's part of that ongoing debate about its real role.
MarketWatch also mentioned some adoption news. Arizona and New Hampshire governors signing bills for Bitcoin reserves. How big a deal is that?
Well, maybe not huge for the price today, but those state-level things are significant steps. It's more mainstream acceptance, right? Governments recognizing digital assets. It adds to the long-term positive story, potentially.
Okay, and with a big jump like this, the technical analysts come out. MarketWatch quoted Tyler Ritchie from the Sevens report on resistance levels. Around $150,500 and $106,500.
Yeah, those are basically price points where you might expect more people to start selling. If Bitcoin can push past those and stay above, it could signal more upside. Maybe retesting that January high he mentioned.
And if it fails?
Could pull back. He also noted support around $93,780. If it breaks below that, could mean a bigger drop is coming.
Gotcha. And lastly on Bitcoin, MarketWatch said MicroStrategy's stock soared, the company that bet big on Bitcoin.
Absolutely. MicroStrategy holds a ton of Bitcoin. MarketWatch had a piece just on that. MicroStrategy's stock surges. Their stock price is now super tightly linked to Bitcoin's price.
So Bitcoin goes up, their holdings are worth more, stock goes up.
Exactly. It's become kind of a proxy way for stock market investors to get Bitcoin exposure, basically.
Okay, let's pivot now. This seems like maybe the biggest cloud hanging over things.
Yeah.
President Trump's tariffs. We've got reports from CNN, Bloomberg, CNBC. They're all showing widespread impact. This isn't theory anymore.
No, definitely not. The effects are getting really tangible, hitting different sectors, different countries. CNN's report from May 9th, Chinese exports to U.S. plummeted in April. That's hard data showing trade flow dropping off a cliff as the tariffs bit.
And the cost to U.S. companies. Bloomberg's piece, from Apple to GM, tariff to cost companies tens of billions, laid out some staggering numbers. GM looking at a $5 billion hit this year, Apple $900 million this quarter, NVIDIA $5.5 billion charge.
Yeah, huge figures. And what really jumped out from that Bloomberg piece was how often companies are using the word uncertainty on earnings calls.
More than during COVID.
Over 9,000 times, apparently, more than the peak uncertainty during the pandemic start. It just shows how much anxiety there is, how hard it is for businesses to plan right now.
And they're scrambling, right? Bloomberg mentioned shifting production, ordering materials early, but also warning about price hikes for us, the consumers.
Yeah, and potential demand drops. It feels like a big, messy global reshuffle is happening.
And it's not just U.S.-China, is it? Bloomberg also noted Japan's early April exports slowed down, likely because of the wider U.S. tariffs hitting cars and other goods.
Exactly. Shows how linked everything is. U.S. policy ripples everywhere.
Now, interestingly, Bloomberg also reported the Trump team might be thinking about cutting tariffs in talks with China, maybe getting below 60%. Is that a sign of hope?
Well, any step back from the brink would probably be welcomed by the markets. But Wendy Cutler, former trade negotiator quoted by Bloomberg, she cautioned that even cutting tariffs in half would still leave them incredibly high historically.
So the economic pain likely continues regardless.
Probably. That level of tariff would still be a major barrier to trade. So, yeah, maybe a positive step, but the headwinds are still strong.
And then there's the U.S.-UK deal. CNBC covered that. Trump's deal with UK sends clear message, 10% tariffs are here to stay. That suggests even for allies, 10% might be the new minimum.
That's a really key insight from the CNBC piece. If the UK, a close partner, gets 10% on most things, it suggests that might be the baseline now.
Other countries might struggle to get better than that.
That's what the analysts quoted by CNBC seem to think. It sets a tough benchmark.
We also saw that piece from CNBC on the aluminum sector. Tariffs were supposed to help U.S. production, but it's not really happening. Why not?
Yeah, that was interesting. CNBC highlighted a big problem: power. The cost and availability of cheap, long-term electricity in the U.S.
Because of AI data centers and stuff?
Apparently that's a big factor driving up demand and prices. So even with tariffs, it's just too expensive to build new aluminum smelters here. The result: tariffs just mean higher prices for U.S. buyers because the cost gets passed on, but not much new domestic production.
So the intended goals protect industry, reshape trade, hitting real-world snags, unintended consequences like higher prices.
That often happens with tariffs, doesn't it? Complex ripples, some benefit, others hurt. Consumers often pay more. That Bloomberg economics estimate you mentioned, potentially hitting U.S. GDP by 2.9%, boosting prices, that shows the potential scale of the damage.
Okay, let's quickly hit a few other economic bits from the week. MarketWatch said Coinbase had a rough quarter, blamed lower crypto prices partly on tariff uncertainty.
Yeah, shows how connected things are. Trade worries hitting crypto exchanges.
But on the flip side, Bloomberg noted Disney raised its profit outlook. Parks and streaming doing well. So, a mixed bag out there.
Definitely. Disney showing some resilience in consumer entertainment, even with the wider economic worries.
We also saw that Bloomberg report about Asia moving away from the dollar for trade, driven by these tensions.
Yeah, that's a long-term trend to watch.
Yeah.
The dollar's still king, but trade tensions and new tech are pushing more deals in other currencies, like the yuan, especially within Asia. It's a gradual shift, but the current environment is speeding it up.
And even the Bank of England. CNN reported they cut interest rates, partly because of lower UK inflation, but they specifically mentioned trade uncertainty from U.S. tariffs.
That's a huge example, isn't it? U.S. trade policy directly impacting another major central bank's decisions. Shows how global these ripples are.
But there's always another side. MarketWatch reported Standard Chartered strategists think Wall Street might be overreacting a bit, that the U.S. economy might handle the tariff disruption better than expected.
It's good to have that counterpoint. Yeah, they pointed to things like inventory buffers, Chinese exporters finding ways to reroute goods, basically suggesting the U.S. economy might be more resilient than feared. Always important to consider those different views.
Definitely. Okay, finally, let's talk Warren Buffett. MarketWatch had an opinion piece digging into why Berkshire Hathaway is sitting on almost $350 billion in cash. $350 billion.
It's just an unbelievable amount of cash.
The author basically suggests Buffett just isn't seeing things he wants to buy right now, and he's worried about government fiscal policy, especially the just print more dollars approach.
Yeah, that piece tried to apply Buffett's thinking to the whole U.S. economy, sees fundamental strengths, but worries about the fiscal management side, the sustainability of it all. Printing money as a fix makes him nervous about the currency long term.
So that huge cash pile is maybe him just waiting for better opportunities if things get rocky.
That seems to be the interpretation, yeah. Classic Buffett. Patience, Waiting for value, preserving capital when things look uncertain or overpriced.
And all this uncertainty, especially from trade, seems to be hitting Wall Street bonuses. Yahoo Finance reported projections are down for most folks this year. That's a turnaround from earlier optimism.
Yeah, the Yahoo Finance piece directly linked lower bonus expectations to the tariffs and the economic fallout. Deal-making slowed down, IPOs especially hit hard.
Except maybe traders. Volatility helps them.
Apparently, yeah. Traders might be the one group seeing potential bumps because the markets have been choppy. But for most, it shows how these big macro policies filter right down to individual paychecks on the street.
So as you can clearly see, the financial world right now is, it's a real mix. You've got these tech shifts with AI challenging search, you've got crypto bouncing around, and then these tariffs sending ripples absolutely everywhere.
It's incredibly dynamic, lots of moving parts, lots of uncertainty.
Definitely a lot for you to think about. These headlines just give you a snapshot, really. We encourage you to dig deeper into anything that caught your ear. Think about how these trends might play out for your own finances.
Absolutely. It's a constantly evolving picture.
We'll be back to track it all. We'll see you on Monday morning with new headlines from major financial magazines.